Good afternoon. Welcome everyone to Sensible Financial Planning's webinar, Charitable Giving in Your Estate Plan. I'm Carrie Fristow, and I'll be the moderator today. Frank Napolitano today will discuss where charitable giving fits into your estate plan. He will also be able to answer your questions, which is super. You have a lot of one-on-one time with a financial planning person. You can see all of our past webinars on Sensible Financial's website at sensiblefinancial.com/webinars. You can also register for upcoming webinars through a link in Sensible Financial's newsletter, which we'll publish later this month, or on that same page, sensiblefinancial.com/webinars. You can have questions all during this, and you can submit them through the Q&A link at the bottom of your window. The chat window, try not to use that. Use the Q&A window. That's preferable. Frank will answer as many questions as he has time for. He can't give personal advice in this setting because there isn't time to gather the information or the proper context. But we will also give Frank's contact information at the end of the webinar, and we will send a recording of this webinar to all the people who registered. Take it away, Frank.
All right. Good afternoon, everybody. Thank you for taking some time out of your day to listen to a webinar on charitable giving and estate planning. Let me get my handy dandy laser pointer here. So my name is Frank Napolitano. I'm a senior financial advisor here at Sensible Financial Planning, offices in Massachusetts and California. Educational background. By the way, I'm a licensed attorney, but very importantly, I'm not a practicing attorney. And so, please don't take any of the educational materials in this webinar as legal advice. That is way beyond what I'm able to do. It's called a Certified Financial Planner Certificate, as well as a Chartered Financial Analyst charter holder. And just a little bit about my charitable interests here. I'm a volunteer board member of Free Flight Exotic Bird Sanctuary, essentially a parrot sanctuary here in Southern California. Beautiful little spot. Today's webinar is going to be about 30 minutes long. And again, at the end of that, I'm trying to stick to my time here. We reserve time for questions. So as questions may arise over the course of this talk, please either remember them or add them to the Q&A section in the Zoom here. We'll sort of curate and go through as many of those questions as possible at the end. The agenda here, I'm going to talk about sort of three things in roughly equal proportion. So number one, reasons for incorporating or thinking about incorporating charitable giving into an estate plan. Why are we talking about this today? Why did I put together this presentation? I'm going to go through some specific giving strategies from simple to complex. There are many more that exist here. So this is very sort of a high level treatment. And then I think some examples with numbers are helpful to sort of break through some of the abstraction and to see how these work out in real life. And to that point, right, this is meant as a sort of very high level treatment of the subject. As we get into more in-depth examples here, I hope you'll see that this raises some complex issues very quickly. So please do not take this webinar or the information in this webinar afterward and start redoing your estate plan. Not at all. I think the purpose here should be to spur some thought, perhaps start a conversation with you and your spouse if you're married, or your family, and hopefully that leads to productive discussions with your other professionals, your estate planning attorney, financial planner, perhaps tax person. So this is really meant to be sort of a issue spotting and idea generating webinar. All right, so let's get to it. So again, the reasons for including or incorporating charitable giving into estate plan. Well, what are the potential benefits? So one, it can reduce estate taxes. I think that's what most people think about when we think about charitable giving and estate planning. Number two, it can prevent essentially spending down financial assets too quickly. And three, it can lead to better planning outcomes. By planning outcomes, I mean very broadly speaking here, a financial plan has lots of components. It can include charitable giving, estate planning, legacy planning. By sort of including all of these into the planning process, I think just leads to better outcomes, and I'll try to support that with some examples. Okay, so let's first talk about estate taxes. So the federal estate tax exemption, the per person exemption today is about $13 million. That's a lot. Very few Americans will get pulled into the federal estate tax regime due to these high exclusion amounts. So why mention it? Well, number one, the exemption is set to expire. It'll sunset in 2026 unless Congress chooses to do something different. If it sunsets at that point, it'll revert back to the previous $5 million limit, adjusted for inflation. But if it does go down to that limit, so many, many more Americans may have a federal estate tax issue at that point. Number two, there are 11 states that have their own estate tax and their own limits, which are not necessarily the same as a federal exemption amount. I'll use Massachusetts as an example, where we have offices where the per person state estate tax exemption is $1 million. Many, many more people get pulled into that state estate tax as a result. And two, what is the import of charitable gifts, or how charitable gifts relate to the estate tax calculation? Well, charitable gifts that are incorporated into estate plan can reduce the taxable estate. And at least in my experience, a lot of people aren't familiar with how estate taxes work because after their lives they've never seen it in practice. I'm going to go through just 2 brief slides here. I explain sort of high level how this works. All right, so estate taxes, like income taxes, are levied against a net number after deductions and an exclusion. So you think about the estate tax formula. Again, this is very high level. As we begin with the gross estate, the gross estate is the value of every piece of property which you own in your name or have an ownership interest in. This is similar to the income tax from the standpoint of the IRS's definition of gross income. Kind of means income from all sources. This is anything to which you might have an ownership interest. Think financial accounts, real property, a home, the value of an annuity, you purchased an annuity, etc., personal property. We subtract from the gross estate deductions. I'll give a list of what those look like in just a second. That leaves us with a taxable estate. We subtract from the taxable estate the exclusion amount. Again, at the federal level, we've seen that's a very large number, but at the state can be much smaller. And that leaves us with a net estate. We multiply that net estate by some tax rate or rates. Again, this is a simplified formula here. It's a progressive tax structure. And that leaves us with the net estate tax liability. And to the point of those deductions, well, what are we allowed to deduct from the gross estate? So funeral expenses, debts. So if you have a house, it's included in the gross estate. If there's a mortgage attached to that house, the mortgage gets to reduce the gross estate by the amount of the mortgage. The amount transferred to a surviving spouse. This is the marital deduction. So this is this married couple, and the first spouse passes away, and in their estate plan they say, I leave everything to my surviving spouse. There's no estate tax due under that set of circumstances. And another deduction is charitable gifts. You can, just as you can under certain circumstances with your income tax, reduce income taxes by making charitable gifts, again, subject to certain rules. So this is where the charitable gifts sort of work into the estate tax calculation. And I'll give a very simple example here, just because I find people understand this better, and it sticks better with real numbers. So same formula here on the left. And let's imagine we're filling out an estate tax return here. And we're starting with the gross estate. It's just in thousands of dollars to reduce the number of zeros on the page. So $3 million estate, reduced by $50,000 in deductions. This might be the funeral expenses, for example. That leaves a taxable estate. We reduce the taxable estate further by the amount of exclusion, for example, a state like Massachusetts, for example, $1 million exclusion amount. That leaves a net estate. We multiply that by some tax rate or rates. These are all made up numbers. I'm not saying this is the estate tax. But under this set of circumstances here, the net estate tax liability would be about $585,000. Again, this is just an illustration. So how does the math change if you include a charitable gift either through a will or a living trust? Well, the gift, in this case, a $450,000 gift, just like to use round numbers here, well, that adds to the deductions, which reduces the tax of the state. The exclusion is the same. The net estate is lower by the amount of the gift. And we multiply, if it's the same tax rate, the net estate tax liability is lower. And if you attended my webinar on charitable giving, inter vivos, or giving during life, you'll notice the way to calculate the tax savings of a gift, similar to the income tax deduction for charitable gifts, is just the value of the gift multiplied by the tax rate, the marginal tax rate. So the difference between 450 and 585 is just $135,000, which is 30% of the amount of the gift. Okay, so charitable gifts, as included in the estate plan, as part of the estate plan, can reduce estate taxes if there otherwise would be estate tax due. There's another important point here, right, is that you have the choice of giving more over time and giving at the end of your life through an estate plan. And the way we do financial planning, if you're familiar with Sensible Financial and you ever financial plan with us, we think about balancing lifetime resources and lifetime expenses, such so that we're trying to help people spend, we're trying to help them live within their means, so not spend more than they can afford. And we call that level of spending at a sustainable level. And when you as a household, an individual, spend at a sustainable level, it means that, so chart just shows financial assets in green and home equity, age 100. If you're spending at a sustainable level, then you are spending your financial assets down over time, such that they last out to your time horizon, or in this case, age 100. So what is the risk here? Well, if you spend more than what you can afford, for example, if you were, come back to the example of charitable giving, right? If you were giving regularly over time, and it turns out that you gave too much over in this case, what is this, a 25-year period, well, those financial assets, instead of lasting to age 100, or what we're planning on here, they may only last to age 90, 91. Okay, so that's the first point. Higher spending can lead to depleting assets prematurely. So if you can push some of that spending out to the future, out to the end of your time horizon, that makes the math work in this example. The other point here is, right, you lose flexibility when you spend, or in our example here, gift more than you can, because you can't take those gifts back, right? Those are irrevocable gifts. And so you lose the flexibility to adapt to, I say one of life's surprises here. We try to do responsible financial planning, but in almost every instance, there are things we did not anticipate. There's expensive healthcare, maybe long-term care, and you could be putting yourself in a difficult position if you gift more now than later. And finally, and this is a point I'm going to come back to throughout the webinar here, right? A holistic approach. We're talking about sort of blending charitable giving plan with an estate plan. I say is more likely to lead to better outcomes. Why? Taxes are, fill in the blank, boring, but complicated. They may also be boring too, but they're certainly complicated. Estate planning is also complicated. And so I will encourage you to think about, carefully about those goals, what you're trying to accomplish, and I encourage everyone listening to this that you're much more likely to reach, to fulfill that goal, or to just sort of get a plan that works the way that you intended if you're working with trusted professionals, competent professionals, and ideally those professionals are talking to each other so the left hand knows what the right hand is doing. I'm going to sort of talk about some giving strategies in just a moment here. We'll start with simple ones, but the important point here is they are simple in isolation, and they're never in isolation, right? Because a decision you make as to respect to an IRA will have down the road consequences for the charity or the next generation. So again, very important to make sure that you're taking a holistic view, a broad view here when updating the estate plan, integrating a charitable giving plan or a legacy plan into your estate plan. Okay, so some giving strategies. So I'm going to walk through some simple strategies here, some simple to more complex. And then I'm going to give some examples that kind of pull together various strands of the issues that you may encounter as you're putting together an estate plan and a charitable giving plan together. But at the outset, I do just have to talk a little bit about probate assets versus non-probate assets, because as they relate to estate planning, it's important to keep that distinction in your mind. So first of all, so what is probate? Probate is simply the name of a legal process that recognizes a will, if there is a will, appoints an executor, and that executor's role is to administer the estate and distribute assets according to the will. It's overseen by a judge process. It's a public process. But for our purposes, distinguishing between probate assets and non-probate assets is important because that difference sort of bears on how you are able to gift a piece of property to an intended beneficiary. So probate assets pass according to a will. The instructions in your will determine how those assets are divided. In general, in general, it's very important because probate assets can become non-probate assets and vice versa. So speaking just very generally here, in general, we're talking about non-contractual assets that are held in an individual's name. So examples would be a bank account owned by myself. A investment account, again, is owned individually. Personal belongings, other type of real property. These are probate assets. Non-probate assets, how do they differ? Well, they pass outside of a will. These types of assets have a beneficiary designation or some other type of ownership that allows them to pass outside of the court process. So examples would be joint accounts, more specifically, joint accounts with rights of survivorship. If there are two owners on a joint account with rights of survivorship, when the first owner passes away, by virtue of the titling on that account, their interest will pass 100% to the surviving owner, and that account does not go through probate. Retirement accounts, IRAs. If you have an IRA or a 401k, you've probably, hopefully, filled out beneficiary designations on those accounts. And if you have, and unless you listed your estate as the beneficiary, or sometimes a trust, which is designed to go through probate, unless you've done one of the two things, that account will pass to that designated beneficiary or beneficiaries outside of the probate process. Some attorneys recommend using living trusts in part as a way to avoid the probate process, and accounts owned in living trusts, again, if they're designed to do so, will pass to beneficiaries avoiding the probate process. Life insurance similarly is a contractual type of account, if you will, with beneficiary designations. Okay, so let's get into some of the strategies here. So strategy one, right? How can someone add a charity to their estate plan. We can name a charity in a will, in which case that's an asset, a probate asset, we just talked about that, or a living trust, and this in general would be a non-probate type of asset. And you can name a charity using a specific bequest. So I hereby give my brokerage account, my stock account to Doctors Without Borders. You could write that in your will. You could write that in your living trust. And that instruction, so long as it's not a whole bunch of other requirements and the account is actually titled the trust, for example, if you're using a trust, that beneficiary, the charity, would receive a specific bequest. It could be a dollar amount, it could be a percentage amount. There are other types of bequests. You could also name a charity as a residuary beneficiary. So after all of your other specific bequests, if there's something left over, that charity receives a portion. A very simple example, we have Joseph and Mary. They have 4 children, and their goal is to leave $500,000 to each of their children, so 4 specific bequests. And they name their favorite charity as a residuary beneficiary, so if anything's left over. So upon the second spouse's passing, they have a $2.75 million estate, and $750,000 goes to charity. Why? Because the children were named as specific beneficiaries to the tune of $2 million, right? 4 times 500,000. And since there's something left over, that leftover, that residuary goes to a charity. Could also combine strategies. Could have just as easily had 4 children and their preferred charity has specific bequests of $400,000 each. And if there is something left over, then their secondary charity would get the remainder. Okay, another strategy. Charity can be named as a beneficiary on a retirement account or life insurance. So again, we're thinking about the distinction more or less between probate and non-probate types of accounts. Generally speaking, accounts with beneficiary designations, well, contractual accounts, let's call them, IRAs, life insurance, transfer on death, sometimes called pay on death accounts. These are accounts that bypass probate, all else equal. Well, you could simply name the charity as a direct beneficiary, and that ensures they will receive the account value in the future. So upon the owner's passing, let's say in the case of an IRA. So let's say Joseph and Mary, same facts. They don't have, you can only own an IRA individually. Let's say Mary has a $1 million IRA. The IRA does not go through probate if there are listed beneficiaries there. And she puts her favorite charity as the 100% primary beneficiary. So when Mary dies, if she doesn't change that beneficiary designation, if the dollar amount stays the same, her charity would receive $1 million directly outside of the probate process. I've seen this done interestingly. I think about a client of mine. Her largest asset is an IRA, just from working her whole life, and she wanted to make sure that her favorite charity got at least $50,000 if she passed away and her husband had predeceased her. She wanted to put it in place so that it would work over time, so that to keep reviewing it every year. So she took her IRA, say $1 million. She took $50,000 and put it into a secondary IRA. She listed her husband as the primary beneficiary and her charity as a secondary beneficiary. So if she were to pass away and, let's say, fail to update her estate plan, her husband had passed away before her, that charity would always get the value of that IRA. And her larger IRA she left to her sister. It gave her peace of mind. It was, again, sort of a simple estate planning strategy to implement. All right, so move from the simple to the complex, the more complex. Again, there's lots of different strategies, but we have to fit this into a 30-minute discussion. So I'm going to talk about sort of special trusts and how they can be used to give to charity. So one strategy here would be to fund a type of irrevocable trust. Irrevocable means you can't take it back. Right? You can claim the income tax deduction for the gift to the charity And this is a two-step process here. The donor here would receive income over the course of their life or for some period of time. This is what's called a charitable remainder trust. I remember it. There are two types. By saying charitable remainder, the charity gets the remainder. Charitable remainder trust. Pictorially, what's going on? Let's say here's Mary. She funds this special instrument, which, by the way, you may have heard from if you went to a large college. Moderates are typically trying to attract their alumni with these types of things. We've seen them over time. Funds this trust. Step one. Step two, the trust makes payments to Mary for her life or for a specified period of years. And upon Mary's death, whatever's left in the trust goes to her charity. It's a little complicated. I'm going to give an example with numbers in just a little bit, so don't worry about it if you're not following me perfectly here. But this is the structure: a charitable remainder trust. Fund a trust, receive income for life or for a period certain, and a gift on your death of the remainder of the trust goes to your charity. There is a slight variation on this. You're just changing the order of things. So we fund the irrevocable trust. It's an income tax deduction for the value of the gift. The charity receives payments for the life of the donor. And then upon the donor's death, whatever's left in the trust goes to some non-charity beneficiary, let's say like a child or surviving spouse. So could be an interesting strategy if you are regularly giving every single year to some sort of charity. You like that idea, but you also want to put something in place to make sure that there is a bequest there for the next generation, and you could set it up today if you so chose. Okay, now to some examples. I know I've been using examples throughout here, but I'll use examples with numbers, and also to sort of prove the larger point here that this is more complicated once you start going down this path and really doing some math. So just two examples, and then we'll finish this up. So example number one, because I was talking about the importance of probate and non-probate assets, I'm going to give an example with a mixing of these two and multiple beneficiaries, as is often the case. So the case I find with a lot of clients, they have charitable intent, but they also have family that they're looking to give to bequest over time. Okay, Paul is 95 years old, and to make it simple, his only property is a bank account and an IRA, right? A, generally speaking, probate account and a non-probate type of account. And he's formulating his estate plan, his charitable giving plan, and he decides that when he dies, he wants to give one half of his estate, remember it's just these two accounts, to Goodwill for charity, and one half to his daughter Sally. Okay, we talked about this already, right? If you want to gift something through a will, this is a will, you could write a specific bequest in that will. I, Paul, hereby give my bank account to Goodwill Industries of Northern New England of Gorham, Maine. You want to be specific with these special bequests. And for his IRA, this is simple. He contacts the custodian of his IRA, his Fidelity, Vanguard, and he asks for a beneficiary form. And he fills out that form and he designates as the primary beneficiary Sally, and fills in her information, her date of birth, her contact information, maybe her social. Okay, so how does this operate? Well, upon Paul's death, his assets pass to his designated beneficiaries, right? So here are the two accounts, we said, one bank account and an IRA. So the bank account passes to Goodwill by means of his will, the specific request he wrote in his will. Goes through the probate process, and after that process is concluded, the executor, writes the check or wires the money to Goodwill. Sally here just receives the IRA. She now is the owner of a beneficiary IRA worth $100,000. Now that is half of his estate in a technically true sense, right? Split right down the middle. But what each of the beneficiaries receives is not 1/2 because of the sort of, we mentioned taxes are complicated, right? Because of the tax character, not only of the assets that are being gifted, but of the tax quality of the recipients. So the cash is cash. There's no tax association or associated tax with cash on the receipt. And goodwill is a charity. They're 501c3, which means they are exempt from taxation. So there's no taxes here. There's no gain. The net gift to goodwill is $100,000. Sally, on the other hand, is an individual, and individuals are subject to all sorts of taxes: income taxes, gift taxes, sales taxes, property taxes, right? When she inherits a $100,000 IRA, she does not receive $100,000. She receives $100,000. She receives $75,000, and the federal and state government receives $25,000. She receives the net of that account after taxes. In this example, because IRAs, most IRAs are pre-tax. Technically, there's a zero basis here. Every dollar taken out is ordinary income. Right? Had Paul attended this webinar, perhaps, or more importantly, had a detailed conversation with his attorney, with his financial planner, perhaps accountant there, he could have had a slightly different estate plan, same dollars, right? His estate is worth $200,000, but instead give the cash to Sally, give the IRA to goodwill, and Sally's better off. This leads to better outcomes, right? Because Sally will inherit the $100,000 free and clear. I'm assuming no estate tax here, but she'll inherit the $100,000 free and clear. The charity receives an IRA, and they say, well, we can't spend an IRA. Fidelity, send us the $100,000 check. They claim it as income, and it makes no difference to them because they're a tax-free entity. Right? So, sort of example number one here, where you can look at some of these strategies, or we looked at some of these strategies earlier, which seem simple on the surface, and viewed in isolation, they absolutely are. But again, a little bit of planning here, a little bit of thoughtfulness, a little bit of, dare I say, professional advice can help avoid some of the pitfalls that exist simply because of the difficulties that exist with navigating what seems like an ever-changing tax code and estate planning rules, et cetera, that are just, that can be complicated. One final example here, because I promised I would talk about the charitable remainder trust with numbers, and this is kind of interesting. Example 2 is just, the benefit of sort of breaking a complex strategy into its components to get an understanding of, does this strategy make sense for me? So again, a charitable remainder trust is 2 things. It's a gift to charity. The amount that you get to take an income tax deduction for is the donated property minus the benefit that you receive, so the value of this annuity, and it's an income annuity, right? So the donor receives income for life, and the charity receives what's left in the trust at the end of the donor's life. You could create your own charitable remainder trust by simply buying an annuity and taking what the cost of the charitable remainder trust would have been, the difference between those two, and giving that to, let's say, your alma mater. So let's look at this way of sort of comparing or answering the question, is the CRT a good deal? And by good deal, I mean, does it allow me to give more to charity than simply buying an annuity and making a gift to charity on my own? So here's some of the numbers. So let's say you're looking to put as much as or exactly $500,000 into this instrument, this charitable remainder trust. In exchange for that $500,000, Great College offers you an annuity for $25,000 per year for life. You've got the annuity for life, and you've got the remainder that goes to Great College. Super Financial I'm not borrowing the same acronyms as Sensible Financial, because Super Financial can sell insurance. We don't sell insurance. We're the only planner. Super Financial is a broker, though, and so they can sell insurance. They can sell life annuities. And they're willing to sell you a life annuity with a $25,000 benefit, the same as great colleges. And the cost of that annuity is $325,000. If your goal is to maximize your gift to great college, what's the better option? All right, so let's turn to charitable remainder trust here for a second. All right, so the total amount of donated property is $500,000. There is a charitable gift. This is the deduction that you're able to claim of $230,000. This is the IRS's calculation. Okay, so they may get more, they may get less, probably not less, but they may get more than that depending on how long you live. But the IRS says you've made a gift worth $230,000. That implies a cost of that annuity. This isn't a price that exists in the marketplace, but that implies a price of $270,000, right? 500 minus 230, 270. Okay, and these are, by the way, I just want to say, these are quotes for illustration purposes only. I did go and find these in the marketplace. I found a college that sells its own CRTs. I also got the annuity quotes here, so these exist, but the quotes will constantly change. So let's look at the alternative, right? An annuity and a gift. You could buy your own annuity. Again, Super Financial will sell you the same annuity that pays $25,000 a year for $325,000. Well, that leaves you with $175,000 left over, which you could give to your alma mater. In this example, that's the charitable remainder trust is a better deal. I had no idea how the numbers would act. I've looked at maybe a dozen of these for clients over the years, and it's almost always been the case that the reverse is true. It's almost always been the case that we end up telling people, if you want an annuity and you want to make a gift to your alma mater, buy an annuity and make a gift to your alma mater. But in this case, anyway, in this specific set of circumstances, the CRT was a better deal. It allowed this person to give more. Just two words of caution here. The one, insurance companies, may be better at running an annuity business. So they're highly regulated. You can find credit rankings for these things, right? And if you're relying on that annuity and you want to be absolutely sure that it's there, you may see reflected in these numbers the fact that there's more default risk by funding the CRT through this college than it is by buying an annuity from this insurance company. That's a risk. That's a consideration, at least. The other point is, right, the annuity and the gift, they may, even if they are more expensive, all else equal, the same credit risk, let's just make the assumption there. This is more flexible. If you want an annuity, you can buy the annuity. If you want to make a gift, you can gift half of this money today. You can gift it over time. You could gift a smaller portion now and put the remainder in your estate plan if you're worried about spending too much. So they're not quite apples to apples, but for purposes of this example, interesting. Right? Okay, so just to summarize here, I know I've gone over a lot. There's a lot of potential pieces here, but the first thing to say, right, there are a lot of potential benefits to incorporating charitable giving into the estate plan. We talked about 3 of them at the outset. Types of strategies that are available range from simple to, I think we've just seen with the CRT, complex, maybe very complex. And yes, special types of trusts can make sense for certain people given their goals. It's really important. I hope these last 2 examples nailed that home. The importance of working with professionals, and it's even better if the professionals talk to each other, right? Because there's overlapping areas of expertise that financial planners can help estate planners with, that can help accountants with. I think that's very important. And finally, right, shouldn't silo these various aspects of the planning process. It's really important to understand how the plan works in its entirety. Think about Paul. If he had known to give the IRA to the charity and the bank to Sally, his daughter would have been better off, right? So really want to think the big picture view here when engaging this type of exercise. So that is the webinar. I have some time here for Q&A, and again, if you have to leave, thank you very much for attending. I hope this was useful.
Oh, Frank, we do have some questions. First of all, we have, if all beneficiaries are in different states, is the estate tax assessed by your home state or by the beneficiary's home states?
So the estate tax is assessed on the estate. I'm speaking sort of federal law here because I know it much better than the 11 state laws that exist. But when somebody passes away, their estate files an estate tax return if they have to. And if there is an estate tax due, it's actually paid. You can think about the order of operations, sort of paid out of the estate first, if there is an estate tax due, and then whatever's left over after that tax, that's what's available to pay various beneficiaries.
Okay. There's another question. Does the new $50,000 limit on QCDs, or qualified charitable distributions, apply only to a gift in exchange for a charitable annuity?
Does the new limit apply only to a gift in exchange for charitable annuity? You know, I do not know. You may be referencing the sort of Secure Act 2.0 change here, and I'm not familiar with it, but Carrie, we have that written down. I think the right way to do it actually is you should email me. My contact information is after this. Send me that in an email. I'd be curious to find out. I don't know the answer to that question.
Okay. We did have another question from John about the Secure Act 2.0 and whether or not that made changes to the QCDs from IRAs.
Sure. I'm sorry. What was it? First, let me just say, for people who may be listening, the one we're throwing out, lingo here: QCD, qualified charitable distribution, not deduction, distribution. See my previous webinar for this. This is an inter vivos, or rather, gift you'd make during life, out of an IRA directly to a charity. It operates similarly as a charitable deduction, except that you always get the benefit of the gift because it's an above the line, it's an exclusion from income rather than a deduction, which might be subject to, deduction limits, standard itemized deduction limits. So that's what a QCD is. Carrie, what was the John's question?
John asked, did the Secure Act 2.0 make changes to QCDs from IRAs, or I'm assuming to some kind of dollar amount?
Yeah, that's a good question. I don't know. The law is so new and it's changed. So ordinarily, or prior to December 31st of last year, the rules for QCDs were generally $100,000 per taxpayer limit. You had to be at least 70 and a half years old. Why 70 and a half? That used to be old RMD age. And it had to be a qualified charity. There were some other rules there. The Secure Act sort of radically changed a lot of the tax code, including RMDs, which will now be 73, and several more years will be 75 for everyone who then turns 75 in 2026, I believe it is. So I don't know the answer to that question. It's on my list of sort of reading to do and sort of unpacking all of the changes in the tax code that happened over the last 2 years in particular.
And yeah, and as Frank said, we will have his email address at the end. So John and Dan, if you'd like to email him with those questions, he can do a little research and find that out for you. We also have a question from Edward. He's interested in more general information about using an irrevocable trust versus or in combination with beneficiary designation.
Using irrevocable trust in combination with beneficiary designation. So I'm trying to define the question a little bit here, but an irrevocable trust, so we're talking about estate taxes, probate versus non-probate. Many times we see people with estate plans which are designed in order to avoid probate. And what does that mean? That means putting together an estate plan that includes a living trust or living trusts, if it's a couple perhaps. That may not have any effect on estate tax. What it does do is more often than not, it's designed to avoid probate. Irrevocable trusts are different from the standpoint that this is often about getting money out of one's estate and perhaps attaching to the benefits that may accrue to beneficiaries certain rules. For example, if you listed your teenage son as the beneficiary on your IRA and they inherited $1 million at age 14, that may not be a good outcome. But that's what beneficiary designations and IRA accounts were. To get around that, you could choose a more complex structure like an irrevocable trust, but the optionality there is huge, and the details really matter. But so depending on what you want to do, irrevocable trust can make sense. I think especially we see it most often in the case of young parents. But yeah, without more information, sorry, it's just hard for me to answer the question.
Carol asks, what are the pros and cons of giving to charity directly from your IRA?
Yeah, okay, good. So talk about the pros, first of all, right? So the pros would be this. And I'm just thinking about like numbers and cents, just tax perspectives here for a second, right? There are emotional benefits to giving money while you are around to see the benefit that it can accrue, right? But I think you're asking just from a dollars and cents perspective. If you are gifting out of an IRA, well, one, it can count against your required minimum distribution. So if you are spending less than what you're getting out of your IRA, and you say, well, I don't know what to do with this money, then it's a very efficient way to give to charity with a QCD. It's efficient because it's excluded from income. It does not matter. I see my previous webinar on this. It does not matter if you take standard deduction or itemized deductions. So again, it's a very efficient way to gift to a charity if you qualify otherwise. What are the cons of this approach? Think back to the very beginning of this webinar. I mean, if you're giving more than you can afford, I'm assuming that you're doing this and there's sort of there's extra. You're living a financial plan and you say, well, I expect to at age 100 have an estate that's greater than zero. But if your financial plan was close, by giving the money now, you lose that flexibility. If you gifted $20,000 a year for 10 years, $200,000 to charity, and at age 92, an expensive health event, or you need long-term care, can't get the dollars back. I think that's the primary con of essentially gifting during life, inter vivos gifting versus gifting through an estate plan or at the end of life.
Okay, Dan, who asked a question before, let's see. I'm trying to remember what he had asked, but he said he found the answer on, oh wait, here's Dan. Dan had asked, does the new $50,000 limit on QCDs apply only to a gift in exchange for a charitable annuity? And he said he found the answer on Fidelity's website.
Okay.
So beginning in 2023, a QCD may be taken to fund a charitable remainder unit trust,
Okay.
a charitable remainder annuity trust, or charitable gift annuity to a maximum one-time amount of $50K.
Interesting. You heard on Fidelity's website, not mine, but that is there's a future blog post there for me on essentially changes to the Tax Act since I gave my last webinar on charitable giving. Thank you, Dan.
Yeah, that's great. Thank you, Dan. And Carol has another question. He says, I've been advised to look at slats or slants. What are these? Ballpark, kind of a broad brush.
Yeah. I debated whether to talk about CRTs and CLTs. I apologize. There's not enough time to get into slats and slants on this thing. These are very complex instruments. They just are.
Okay, so maybe Carol could also write you a note, or maybe that's a future blog post or a future webinar.
That's a good point. I've not written about either the changes with Secure Act 2.0. I don't know them yet. I haven't researched enough yet, but yeah, there are probably in my future sort of advanced or with complex charitable giving strategies article or articles out there that could be really interesting. So I'll put that on my list of topics to revisit in future, Carol, for future writings. Which, by the way, I should plug our blog. All of the writings we do and the research we do is internally done, so we don't hire out for any research or things like that. There's a lot of good, I would say, original articles up there on our blog that go back years and years. So check it out.
Yeah. Well, I think they've answered the questions from today. Yeah, and if you do want to look at the blog, the website for that is sensiblefinancial.com/blog. As is the webinars. If you're interested in any other webinars, the past webinars that Frank has mentioned in this particular webinar are all available on the webinars page on the Sensible website, which is sensiblefinancial.com/webinars. And but did you want to? Okay, and the next webinar that we have coming up is going to be Rick Miller, and it's his top 10 principles of financial planning. That's going to be on March 23rd at 2 p.m. And you can sign up for that on Eventbrite, and there is a link to that on the Sensible Financial website. And thanks very much for coming today. If you'd like any more information on charitable giving, estate planning, or any matter involving financial planning, please contact Frank at Napolitano at sensiblefinancial.com. And it's right below his picture.
That's right. And thank you for the very thoughtful questions. Those were good, and give me some homework here and some things to think about. So thank you. I hope this was useful for everybody.